Question 1. Which of the following best describes the primary function of proportional reinsurance? A. To transfer the risk associated with catastrophic events to a reinsurer in exchange for a fixed percentage of the premium. B. To provide reinsurance coverage for losses above a specific threshold typically associated with high-value claims. C. To equally distribute all underwriting risks between the insurer and reinsurer based on a fixed percentage of premiums. D. To indemnify the primary insurer against a set of risks ensuring that only a portion of the liability is shared. Answer C. Explanation. Proportional reinsurance is structured such that the primary insurer and the reinsurer share the premiums and losses based on an agreed-upon percentage. This includes both the risks and premiums related to the policies written by the primary insurer. The key feature of proportional reinsurance is that the reinsurer assumes a fixed percentage of the insurer's premiums and losses. That is incorrect because this option describes excessive reinsurance, not proportional reinsurance. Excessive loss reinsurance helps insurers recover from catastrophic events but does not involve a fixed percentage of premium sharing. B is incorrect as it refers to excessive loss reinsurance, not proportional reinsurance. Excessive loss focuses on covering losses above a set threshold. D is incorrect because it implies the reinsurer assumes specific risks without sharing premiums in a proportional, which doesn't align with how proportional reinsurance works. Question 2. Scenario question. Mr. Williams is an insurer who has been using excessive loss reinsurance for years. Due to an increase in climate-related disasters, his claims volume is rising and he finds himself exceeding his retention limit regularly. He is considering switching to a stop-loss reinsurance model. Which of the following would most likely be the main advantage of Mr. Williams switching to stop-loss reinsurance? A. It would allow him to cover individual risks above a specific limit more efficiently. B. It would provide coverage for aggregate losses across a defined period, not just single claims. C. It would allow for greater retention, reducing his overall reinsurance costs. D. It would ensure that his claims settlement process becomes more streamlined with fewer intermediaries. Answer B. Explanation. Stop-loss reinsurance provides coverage for aggregate losses over a specific period, such as a year, rather than covering individual claims above a certain retention level, which is typically the case with excessive loss reinsurance. The main advantage here is that stop-loss reinsurance covers a broad range of losses aggregate within the policy period. Helping Mr. Williams control overall exposure is incorrect. Excessive loss reinsurance is the model used to cover individual claims above a specified threshold, not stop-loss. C is incorrect as stop-loss typically doesn't reduce retention limits. Rather, it offers protection against cumulative losses. D is incorrect because stop-loss reinsurance does not inherently streamline the claims settlement process but focuses on financial protection from cumulative losses. Question 3. Which of the following clauses in a reinsurance agreement typically defines the terms under which the reinsurer's liability is limited and specifies what risks are not covered? A. Coverage and exclusions clause. B. Insolvency clause. C. Payment provisions clause. D. Retention and limits clause. Answer A. Explanation. The coverage and exclusions clause outlines the specific coverage provided by the reinsurance agreement and the risks that are excluded from coverage. This is critical as it clearly defines the boundaries of what is covered and what is not, ensuring both the reinsurer and the primary insurer are aware of their obligations and responsibilities. B is incorrect because the insolvency clause typically specifies what happens if the primary or the reinsurer becomes insolvent, but it doesn't focus on coverage and exclusions. C is incorrect because the payment provisions clause deals with how payments are made between the insurer and reinsurer, not coverage or exclusions. D is incorrect because the retention and limits clause defines the amount the primary insurer retains before the reinsurer's liability kicks in, but it doesn't address the specific coverage or exclusions. Question 4. Which of the following is most likely to be the primary reason for an insurer to use facultative reinsurance rather than treaty reinsurance? A. The insurer needs to manage large, unique, or high-risk policies on an individual basis. B. The insurer is looking to share risks across an entire portfolio of policies automatically. C. The insurer wants to reduce its regulatory reporting requirements and paperwork. D. The insurer seeks to cover only aggregate losses from a specific set of risks. Answer and explanation. Facultative reinsurance is typically used for individual risks or policies that may be too large or unusual for automatic coverage under a treaty reinsurance agreement. This allows the insurer to negotiate reinsurance terms for specific high-risk or large policies, ensuring that the risk is properly managed. B is incorrect because treaty reinsurance, not facultative, is used to automatically cover a broad range of risks in a portfolio. C is incorrect because facultative reinsurance involves more individual assessments and negotiations, which typically lead to higher administrative burdens. D is incorrect as facultative reinsurance does not focus on aggregate losses, but rather on specific individual risks or policies. Question 5. Which of the following best describes the function of a reinsurance treaty? A. It provides coverage for specific individual risks based on an agreed-upon contract. B. It is an agreement in which the primary insurer transfers a specified portion of its risks to the reinsurer automatically over a certain period. C. It allows the insurer to select certain policies for reinsurance coverage based on individual assessment. D. It sets a fixed premium for all policies that the reinsurer will cover under a agreement. Answer. B. Explanation. A reinsurance treaty is an agreement between the primary insurer and the reinsurer in which the reinsurer automatically covers certain types or classes of risks, typically over a set period. The treaty defines the terms and conditions of the coverage, including the proportion of risks transferred and premiums to be shared. It is incorrect because it describes facultative reinsurance, where individual policies are assessed and covered. Incorrect because this describes facultative reinsurance, not treaty reinsurance, which involves automatic coverage of a class of risks. D is incorrect as the reinsurance treaty focuses on the risks covered and the premium sharing arrangement, not a fixed premium. Question 6. Which of the following is most important when determining the pricing of reinsurance contracts? A. The reinsurer's historical claim settlement performance. B. The underlying risk profile of the insurer's portfolio and exposure. C. The reinsurer's brand reputation in the market. D. The legal jurisdiction under which the reinsurance contract is written. Answer. B. Explanation. The pricing of reinsurance contracts is primarily based on the risk profile of the underlying portfolio and the exposure to losses. The reinsurer assesses factors such as the frequency and severity of claims, as well as the potential for catastrophic losses, in order to determine an appropriate premium to charge the primary insurer. It is incorrect as while historical claim performance is relevant, it is not the primary factor. Pricing reinsurance contracts. C is incorrect because the reinsurer's brand reputation does not play a direct role in the pricing of a reinsurance contract. D is incorrect as the legal jurisdiction is important for regulatory compliance but not directly related to the pricing of reinsurance. Question 7. What is the primary benefit of using excessive loss reinsurance for an insurer? A. It reduces the overall premiums the insurer pays for coverage. B. It provides coverage for aggregate losses over a certain period or risk class. C. It allows the insurer to retain a large portion of the risk and share losses only above a specified threshold. D. It automatically covers all claims within the insurer's portfolio, including small and large losses. Answer. C. Explanation. Excessive loss reinsurance allows the insurer to retain a portion of the risk while the reinsurer covers losses above a specified threshold retention limit. This is especially beneficial for covering catastrophic or large losses that exceed the insurer's capacity. It is incorrect as excessive loss reinsurance does not typically reduce overall premiums, but instead focuses on managing large losses. B is incorrect because excessive reinsurance does not cover aggregate losses over a period, but instead focuses on individual losses exceeding a set threshold. D is incorrect because excessive loss reinsurance focuses on losses above a specified retention limit, not covering all claims automatically. Question 8. Which of the following is typically included in the financial reporting and disclosure obligations of a reinsurer? A. The total number of policies written and the premium collected from each. B. The aggregate losses covered by the reinsurance agreements and reserves for unpaid claims. C. The administrative costs of processing claims on behalf of the insurer. D. The number of reinsurance contracts signed with each insurer and the payment terms. Answer. B. Explanation. Reinsurers are required to report the aggregate losses covered by their reinsurance agreements and provide detailed information on reserves for unpaid claims. This helps regulators and stakeholders assess the financial stability of the reinsurer and its ability to meet future claims obligations. is incorrect because the total number of policies written and premiums collected is more relevant to the insurer's reporting, not reinsurer. C is incorrect as administrative costs for claims processing are typically not the focus of the reinsurer's financial disclosures. D is incorrect because the number of contracts and payment terms are important but are not the primary focus of financial reporting, which emphasizes losses and reserves. Question 9. Which of the following would be considered an emerging trend in reinsurance that involves technology and innovation? A. The shift towards using aggregate excessive loss reinsurance to cover all risks automatically. B. The incorporation of cyber risk coverage and the development of cyber reinsurance solutions. C. The use of traditional risk pooling models to share insurer liabilities more efficiently. D. The expansion of facultative reinsurance for more standardized policies and risks. Answer. B. Explanation. One of the emerging trends in reinsurance is the incorporation of cyber risk coverage, where reinsurers provide specialized products to cover cyber risks, which have increased significantly due to the rise in cyber threats and attacks. This trend is driven by the need for insurers to cover risks that were not traditionally included in standard policies. That is incorrect because excessive loss reinsurance covers individual large, not automatically all risks. C is incorrect as traditional pooling models are not an emerging trend but rather an established practice. D is incorrect because facultative reinsurance is used for specific, high-risk policies, not for standardized risks. Question 10. In a reinsurance treaty, the retention limit defines a. The amount of risk that the primary insurer is responsible for before the reinsurer steps in. B. The total amount of premiums the primary insurer must pay to the reinsurer for coverage. C. The maximum amount of loss that the reinsurer will pay for any individual claim. D. The number of claims that the reinsurer is required to cover under the treaty. Answer A. Explanation. The retention limit is the amount of risk that the primary insurer retains before the reinsurer becomes liable for losses. This is a key feature of both treaty and facultative reinsurance agreements, as it defines the threshold for when the reinsurer's coverage applies. B is incorrect because premiums are not defined by the retention limit but by the reinsurance contract terms. C is incorrect because retention relates to the risk the insurer retains, not the individual claim payment. D is incorrect because the retention limit does not dictate the number of claims covered but the amount of risk the insurer retains before the reinsurer assumes responsibility. Question 11. Which of the following best describes the purpose of stop-loss reinsurance? A. To limit the primary insurer's total liability by covering losses that exceed a specified amount. B. To protect the reinsurer from taking on too much risk in high-risk areas. C. To cover individual large claims that exceed the insurer's retention limits. D. To allow the insurer to automatically reinsure all policies within portfolio. Answer A. Explanation. Stop-loss reinsurance is designed to limit the primary insurer's total liability by providing coverage for losses that exceed a specified aggregate amount. This helps protect the insurer from catastrophic or excessive losses that may occur over a defined period. B is incorrect as stop-loss reinsurance does not primarily protect the reinsurer but the insurer from large aggregate losses. C is incorrect because stop reinsurance covers aggregate losses, not individual claims. D is incorrect as stop-loss reinsurance does not involve automatic coverage of all policies, but rather coverage for losses exceeding a set threshold. Question 12. In which scenario would a reinsurer likely invoke a commutation clause in a reinsurance agreement? A. When the insurer wants to buy back coverage for a specific risk that was previously transferred. B. When the reinsurer seeks to increase the premiums paid by the insurer for the treaty. C. When the reinsurer identifies significant underperformance in the risk pool. D. When the insurer has reached the maximum coverage limit under a treaty. Answer A. Explanation. A commutation clause in a reinsurance agreement allows the insurer and reinsurer to settle their obligations early, often by repurchasing reinsurance coverage or paying a lump sum to terminate the reinsurance agreement. This is typically invoked when the insurer seeks to buy back coverage on a particular risk. B is incorrect because commutation does not involve renegotiating premiums but settling the reinsurance early. C is incorrect as commutation is not invoked to address underperformance in the risk pool but to resolve contractual obligations. D is incorrect because the commutation clause is unrelated to hitting a coverage limit but rather to settling the agreement early. Question 13. Mr. Smith is an insurance company owner in Michigan. His company is facing a catastrophic event with multiple claims that have already exceeded their retention limits. What is the primary benefit of utilizing excessive loss reinsurance in this scenario? A. To cover all claims regardless of size without any limitations. B. To protect the company from large losses by covering the portion of the loss that exceeds the retention limit. C. To ensure all claims are handled by the reinsurer directly. D. To reduce the overall premiums paid for reinsurance coverage. Answer. B. Explanation. Excessive loss reinsurance is used to cover losses that exceed a certain threshold retention limit. In Mr. Smith's scenario, this type of reinsurance would help protect his company from large catastrophic losses, ensuring that the reinsurer covers only those losses that exceed the retention limit. Is incorrect because excessive loss reinsurance only covers losses above the retention limit. Not all claims. C is incorrect because excessive reinsurance does not automatically involve the reinsurer in claims handling but focuses on coverage above the threshold. D is incorrect because excessive loss reinsurance is designed to manage large losses, not necessarily reduce overall premiums. Question 14. Which of the following is a key factor considered by reinsurers when determining pricing for reinsurance contracts? A. The insurer's administrative overhead costs. B. The risk profile of the underlying policies, including claim frequency and severity. C. The market share of the primary insurer in the industry. D. The reputation of the reinsurer in the global market. Answer. B. Explanation. The primary factor in pricing reinsurance contracts is the risk profile of the underlying policies. Reinsurers assess the frequency and severity of claims in the portfolio, as well as the potential for catastrophic losses in order to determine an appropriate premium for the coverage. That is incorrect because administrative costs are less relevant than the actual risk profile when pricing reinsurance. C is incorrect as the market or the insurer is not a primary factor in pricing reinsurance. D is incorrect because while the reinsurer's reputation is important for other reasons, it does not significantly impact reinsurance pricing. Question 15. What is a potential disadvantage of utilizing quota share reinsurance for an insurer? A. The insurer retains a larger portion of the risk in case of a loss. B. The insurer may have to cede a larger percentage of premium than it would in excessive loss reinsurance. C. The insurer must handle all claims directly without reinsurer involvement. D. The insurer is required to buy back coverage after a certain period. Answer. B. Explanation. In quota share reinsurance, the insurer cedes a fixed percentage of premiums and losses to the reinsurer. This means the insurer may have to cede a larger portion of its premium compared to other types of reinsurance like excessive loss, where the insurer retains more risk and only cedes claims above a certain threshold. Is incorrect because in quota share reinsurance, the reinsurer shares both the premiums and the losses. Insurer's overall retention. C is incorrect because quota share reinsurance typically involves the reinsurer's participation in claims handling. D is incorrect as quota share reinsurance does not involve buying back coverage. Question 16. What is the primary regulatory body overseeing reinsurance activities in Michigan? A. The National Association of Insurance Commissioners, NAIC. B. The Michigan Department of Insurance and Financial Services, DIFS. C. The Federal Insurance Office, FIO. D. The U.S. Securities and Exchange Commission, SEC. Answer. B. Explanation. In Michigan, the Michigan Department of Insurance and Financial Services, DIFS, is the primary regulatory authority overseeing insurance and reinsurance activities, ensuring compliance with state laws and regulations. It is incorrect because while the NAIC provides model laws and guidelines, it is not the specific regulatory body for Michigan. C is incorrect as the Federal Insurance Office does not directly reinsurance in Michigan. D is incorrect because the SEC oversees securities, not insurance or reinsurance activities. Question 17. Which of the following is a characteristic of facultative reinsurance? A. It automatically covers all policies in a specific class of risk. B. It allows the reinsurer to assess individual risks on a case-by-case basis. C. It applies to large and unique portfolios of risks. D. It does not involve negotiations between the insurer and reinsurer. Answer. B. Explanation. Facultative reinsurance allows the reinsurer to assess and accept individual risks on a case-by-case basis. This is typically used for large or unique risks that cannot be automatically covered under A treaty reinsurance agreement is incorrect as facultative reinsurance is not automatic but rather selective, covering individual policies. C is incorrect because facultative reinsurance is typically used individual risks, not large portfolios. D is incorrect because facultative reinsurance requires negotiations between the insurer and reinsurer. Question 18. What is the primary function of an insolvency clause in a reinsurance agreement? A. To specify the reinsurer's obligation to cover all claims in the event of the insurer's insolvency. B. To allow the reinsurer to terminate the agreement in case of market instability. C. To ensure the insurer is paid fixed amount regardless of losses. D. To outline the procedures for handling claims if the reinsurer becomes insolvent. Answer A. Explanation. An insolvency clause in a reinsurance agreement ensures that the reinsurer will continue to fulfill its obligations to cover claims even if the primary insurer becomes insolvent. This helps provide financial stability and protection for the insurer's policyholders. B is incorrect because an insolvency clause does not allow the reinsurer to terminate the agreement but ensures the insurer's obligations are met. C is incorrect as insolvency clause relates to claims payments, not fixed amounts. D is incorrect as the insolvency clause focuses on the insurer's insolvency, not the reinsurer's. Question 19. Which type of reinsurance contract is best suited for an insurer seeking to cover large, catastrophic losses without ceding significant portions of their premiums? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Stop loss reinsurance. Answer B. Explanation. Excessive loss reinsurance is designed to cover large, catastrophic losses that exceed a specified threshold, allowing the insurer to retain most of the premiums while being protected from severe losses. It is incorrect because quota share reinsurance involves ceding a fixed percentage of premiums, which is not ideal for covering catastrophic losses. C is incorrect because facultative reinsurance is more suited to individual high-risk policies, not large, catastrophic losses. D is incorrect because stop-loss reinsurance focuses on aggregate losses over time rather than covering large individual losses. Question 20. What does the term reinsurance recoverables refer to? A. The total amount of premiums paid to the reinsurer by the insurer. B. The reinsurer's potential liability for unpaid claims under the reinsurance agreement. C. The insurer's obligation to pay a portion of claims to the reinsurer. D. The amount of losses the insurer expects to recover from the reinsurer. Correct answer. D. Explanation. Reinsurance recoverables refer to the amount of losses that the insurer expects to recover from the reinsurer, typically for claims that fall within the coverage provided by the reinsurance agreement. It is incorrect as premiums paid to the reinsurer are not considered recoverables, but part of the contractual arrangement. B is incorrect because recoverables relate to amounts the insurer can claim, not the reinsurer. Potential liability for unpaid claims. C is incorrect because reinsurance recoverables are about the insurer recovering amounts from the reinsurer, not the insurer's obligation to pay the reinsurer. Question 21. What is the primary purpose of a treaty reinsurance agreement? A. To allow the insurer to cede individual risks to the reinsurer on a case-by-case basis. B. To automatically cede all risks from a defined category to the reinsurer. C. To provide coverage for large, catastrophic losses only. D. To transfer the insurer's administrative duties to the reinsurer. Answer B. Explanation. A treaty reinsurance agreement involves an automatic arrangement where the insurer agrees to cede a defined category of risks to the reinsurer. This type of reinsurance covers all the risks within the specified category, ensuring the insurer has a stable relationship with the reinsurer. Is incorrect because this refers to facultative reinsurance, not treaty reinsurance. C is incorrect as treaty reinsurance can cover full and large risks. D is incorrect because treaty reinsurance does not transfer administrative duties but focuses on risk transfer. Question 22. In a pro rata reinsurance agreement, the reinsurer typically A. Pays a fixed sum in exchange for a percentage of the premiums and claims. B. Assumes all the risks associated with the underlying policies. C. Retains a higher portion of the premiums than the primary insurer. D. Provides coverage only for catastrophic losses. Answer A. Explanation. In a pro rata reinsurance agreement, the reinsurer assumes a fixed percentage of both premiums and claims based on the terms of the agreement. This arrangement is more predictable as the reinsurer shares both the profits and losses proportionally. B is incorrect as the reinsurer does not assume all risks but shares in the risk proportionally. C is incorrect because the reinsurer typically receives a percentage of premiums, higher portion than the primary insurer. D is incorrect as pro rata reinsurance is not limited to catastrophic losses. It applies to the entire category of policies. Question 23. How does a retrocession agreement function in the context of reinsurance? A. It allows a reinsurer to transfer some of its own risk to another reinsurer. B. It gives the insurer the right to terminate the reinsurance contract at any time. C. It automatically includes all policies under a reinsurance treaty. D. It focuses solely on covering individual claims, not portfolio risks. Answer. Explanation. A retrocession agreement allows a reinsurer to transfer some of the risks it has assumed from the insurer to another reinsurer. This helps the reinsurer manage its own risk exposure. B is incorrect as retrocession does not give the insurer termination rights. C is incorrect because retrocession involves transferring risk from a reinsurer to another, not the automatic inclusion of policies. D is incorrect as retrocession focuses on portfolios, not individual claims. Question 24. What is the primary concern when a reinsurer faces adverse selection? A. Accepting risks that are more favorable than expected. B. Failing to diversify its portfolio properly. C. Insuring only high-risk policies that are more likely to result in claims. D. Reducing the overall premiums charged to the insurer. Answer. C. Explanation. Adverse selection occurs when a reinsurer insures high-risk policies that are more likely to result in claims, which leads to a higher than expected loss ratio. This typically happens when the reinsurer does not have enough information to properly assess the risk. It is incorrect because adverse selection is about accepting higher-risk policies, not favorable ones. B is incorrect because adverse selection relates more to risk assessment. Portfolio diversification. D is incorrect because adverse selection does not concern premium reductions but an imbalance in the types of risks covered. Question 25. What type of reinsurance is typically used to cover specific large risks such as a natural disaster? A. Quota share reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer. C. Explanation. Excessive loss reinsurance is used to cover large catastrophic losses, such as those resulting from a natural disaster. This type of reinsurance covers losses above a specific threshold, protecting the insurer from large claims. It is incorrect because quota share reinsurance involves proportional sharing of risks, not the focus on large catastrophic events. B is incorrect because facultative reinsurance is used individual risks, not specifically for large events. D is incorrect because stop-loss reinsurance covers aggregate losses over a period, not individual catastrophic events. Question 26. Which of the following is the potential benefit of reinsurance for insurers? A. The ability to retain all premiums without sharing with a reinsurer. B. Increased capital requirements to back up policies. C. Reduced volatility in earnings and risk management. D. A guaranteed profit margin from the reinsurer. Answer. C. Explanation. Reinsurance allows insurers to reduce the volatility in earnings and better manage their risks. By transferring some of their risks to reinsurers, insurers can stabilize their financial performance and reduce the likelihood of large losses. It is incorrect as reinsurance involves sharing premiums and claims with a reinsurer. B is incorrect because reinsurance can actually reduce the capital requirements for the insurer as it transfers some of the risk. D is incorrect because while reinsurance helps mitigate risk, it does not guarantee a profit margin. Question 27. In a reinsurance contract, what does the term retention limit refer to? A. The maximum amount of loss the reinsurer will cover. B. The amount of risk the insurer retains before the reinsurer steps in. C. The amount of premium the insurer must pay to the reinsurer. D. The total amount of coverage provided by the reinsurance agreement. Answer. B. Explanation. The retention limit refers to the amount of risk that the insurer retains before the reinsurer begins to cover additional losses. This is a key concept in both excessive loss and pro rata reinsurance agreements. It is incorrect because the retention limit is about the insurer's portion, not the reinsurer's. C is incorrect because the retention limit refers to risk retention, not the amount of premiums paid. D is incorrect because retention limit does not refer to the total coverage but to the insurer's retained portion of risk. Question 20. What is the typical role of the reinsurer in facultative reinsurance? A. To automatically cover all risks that the insurer chooses. B. To provide coverage only for large, unique risks on a case-by-case basis. C. To share a percentage of the insurer's premiums without assessing the risks. D. To cover only catastrophic losses exceeding specific threshold. Answer: B. Explanation. In facultative reinsurance, the reinsurer assesses and agrees to cover individual large or unique risks on a case-by-case basis. This is different from treaty reinsurance, where risks are automatically ceded to the reinsurer based on predetermined terms. That is incorrect because facultative reinsurance does not automatically cover all risks, but evaluates each risk individually. C is incorrect because reinsurance involves the reinsurer assessing individual risks, not sharing premiums without assessment. D is incorrect because this describes excessive loss reinsurance, not facultative reinsurance. Question 29. Which of the following is a characteristic of a non-proportional reinsurance agreement? A. The reinsurer shares a fixed percentage of premiums and claims with the insurer. B. The reinsurer only covers losses that exceed a certain threshold. C. The reinsurer covers all individual claims on a case-by-case basis. D. The insurer receives a fixed premium amount for each policy. Answer: B. Explanation. In non-proportional reinsurance, e.g. excessive loss, the reinsurer only covers losses that exceed a specific threshold. This type of reinsurance does not involve sharing premiums and claims proportionally, but focuses on covering large individual losses. It is incorrect because non-proportional reinsurance does not involve sharing fixed percentages of premiums and claims. C is incorrect because covering individual claims on a case-by-case basis is characteristic of facultative reinsurance. D is incorrect as non-proportional reinsurance involves thresholds, not fixed premium amounts per policy. Question 30. What is the primary reason an insurer might use a reinsurance intermediary? A. To handle all claims under the reinsurance agreement. B. To negotiate favorable terms with reinsurers and manage contracts. C. To automatically transfer risk to the reinsurer without further assessment. D. To ensure that the reinsurer's financial position is monitored regularly. Answer: B. Explanation. Reinsurance intermediaries play a key role in negotiating favorable terms with reinsurers, managing contracts, and facilitating communication between insurers and reinsurers. They help optimize the reinsurance process. That is incorrect because intermediaries do not handle claims. They focus on the contract and negotiations. C is incorrect because reinsurance intermediaries help negotiate and assess the terms of reinsurance agreement. D is incorrect because the intermediary is not responsible for monitoring the reinsurer's financial position.